Welcome back. This is Lesson 6 in the Partners for Housing Multifamily Preservation Training. I'm Gates Dunaway with Tapestry Development Group. I'm going to do this session and the next by myself. My fearless leader is not a part of this, but Margie Masonette has been a big part of this whole training, and we appreciate her participation and help there. So with no further ado, this is about a 30-minute lesson, and so we'll have this lesson, and it'll run hopefully till about 1:45, and then come back at 2:30 for another 30-minute lesson or so on the tax credit preservation strategies. So let's look at the first slide, Lesson 6. This is the Sustaining Affordable Housing Through FHA Refinancing. The objectives of this lesson are: first, we're going to identify the steps that are required to apply for an FHA-insured loan to refinance or rehab your HUD property. And we're going to identify the property and owner eligibility requirements and the incentives associated with obtaining FHA insurance through the 223F or the 221D4 program. Topic 6.1, applying for an FHA-insured loan. We're going to go through the actual process of that. So before we go into the actual steps, I want to take a minute to talk about what we've been doing and how it leads up to where we are today. The first 5 lessons the first 5 lessons teach you what it is you have with your property. The point of those lessons is to show you what you have, the hurdles you might have to, the barriers you might have to preserving and to getting new financing. So we learned what you might need to do if you have a 202 property, what you might need to do if you have a 236 property. For your Section 8 contracts, how you go about getting and maximizing your renewal options. The idea of this path was to get you to understand your property, know where you are, and once you understand where you are and what your potentials are, now we're entering into the phase of what kinds of new financing you can achieve in order to, for instance, prepay your 202, achieve your capital needs, and move ahead with a pure preservation strategy. So let's look back at the applying for an FHA-insured loan to refinance or rehab your HUD property. The first bullet is that the loan underwriting for HUD-insured loan programs, it's performed by a HUD-approved lender under the MAP, the MAP lending program. And if you go to the HUD website, you'll find a list of MAP-approved lenders that you would want to work with. You must note that you have to work with a MAP-approved lender. The lender works with the owner to underwrite the loan, and I'll make a point here. This is a lender-driven process in that the lender is responsible for putting the application together, sizing your loan, and getting your application into HUD. However, the owner is the most important part of this process. You need to be able, as an owner, to know what it is you want to achieve and your path to achieving that. You are your own best advocate as you work with your lender. The lender submits the application to the HUD field office, and then HUD reviews, approves, and endorses the loan. The loan is funded by the MAP lender, and HUD provides the mortgage insurance and pays the claim in the event of a default. So this is what we call HUD. HUD-insured mortgage is just that. The lender makes the loan, and then there's a mortgage insurance premium, MIP, which we'll talk about in a second, that's paid in addition to the interest rate on the loan. That mortgage insurance premium that's paid to HUD is the insurance premium that insures the loan to the lender. So if something were to happen in the event of a default, HUD would basically pay the default off to the lender. The last little step in this process is owners should contact the local HUD office to discuss your plans, obtain advice, and the best possible fit for a loan. And then you should contact your MAP lender. And then the last bullet says the lender drives the process. Again, the owner is the most critical piece of the process, but the lender is the entity that keeps it going forward and understands what's going on. But the owner should not lose sight of the fact that you as an owner must set up your criteria for success and what it is you want. And then also not to dwell too much on it, it's very, very important as you go about this process that you're constantly talking to HUD. You need to have your concept meeting as early as possible to let them know what your intent is, how you'd like to achieve your intent, and if there's anything you need to know that office might want to tell you. And that's how you get a good partner out of your local HUD office. So we're going to first look at the 223F programs, topic 6.2, we call it Section 207, but we also refer to it affectionately as the 223F. And then the next is the Section 221D4 after that. The 223F program is used to purchase or refinance existing multifamily projects. They're meant for projects that do not require substantial rehab. We call this the repair program, and it's in contrast to substantial rehabilitation. The repairs cannot exceed the greater of $6,500 a unit multiplied by your HUD high cost factor for that area. And if you go to the HUD website, you can find the HUD high cost factor. Right now it's in Notice 2011-13, which was issued in July 22nd of 2011. If you multiply you find your area on that list, and it's a multiplier that you multiply by $6,500. That's going to be the upper limit on how much you can spend per unit to do the repairs under the 223F program. You also cannot exceed 15% of the estimated replacement cost after the completion of the repairs and improvements. So if you were to calculate what 15% of building your project from ground up would be, you cannot exceed that number. And then you also are not supposed to be completing more than one major building replacement. And so a major building component, again, we discussed in an earlier lesson, would be roof replacement, window replacement, whole kitchen replacement, HVAC system replacement. Now, I will tell you there's some flexibility in this. HUD understands that at some, in some areas, the HUD high cost factor might be closer to 300%. So you may be looking at an upward limit of almost $20,000 per unit you could spend under this program. It is just about impossible to do $20,000 a unit of repairs or up to that and not replace more than one major building system. So I want to tell you there's some flexibility in that, and there's some flexibility with the interpretation of that. The primary goal of all of these limitations is because of some other advantages of the F program that we're going to talk about. HUD doesn't want you going into a substantial rehabilitation mode under the F program because they don't have the program set up to properly monitor and make sure that you're doing things according to code. So if you slip into doing the kinds of repairs that would typically require architectural plans and drawings and fairly complicated, you could slip into where you're exceeding these limits, and they would ask you to look at the substantial rehabilitation program. But if you are doing more than one major building replacement, don't assume it wouldn't fit under the F program. Talk to your local office about that. And then the last caveat on my slide says that if you do exceed these limits, you may be a better fit under the D4. Again, just to reiterate, what we're going to talk about when we talk about the 221 D4 program, it is for substantial rehabilitation. So if any collection of all of these criteria begin to look like substantial rehabilitation, then that's the direction that the HUD office would want you to go into. Some more requirements of the 223F program. You must not have less than 5 units in your property. The most recent renovation or the original construction of your building must be at least 3 years or older unless you get a waiver that's granted by HUD, and that is possible, especially under the pilot program that we're going to talk about. It allows for critical repairs as determined by the PCNA, the Project Capital Needs Assessment, which of course must be completed prior to closing, and then the non-critical repairs, and those must be completed within 12 months of closing. So to expand on this, the critical repairs and the non-critical repairs, those will be determined in a project, in a PCNA. The PCNA will be ordered by your lender, and we have a lot of discussion in our workshops about the PCNA and the complications around the PCNA, where the client, which I would call the client being the owner, the PCNA indicates that a long list of things need to be done that don't fit into the budget, or items need to be done that are in conflict with what the owner would do. And I would just caution you that the entire process of ordering the PCNA should be have a lot of involvement by the owner of the property. Before you even have the lender order your PCNA, you should be creating your own capital needs expectations, capital needs replacements list, and you should also be doing your own owner wish list. If you had an unlimited amount of funds, what would you do and what would be the priority of those things? We also advise, if it's at all possible, for owners to go ahead and to estimate pricing associated with the things they'd like to do. The folks that do the PCNAs are typically national firms, and sometimes they will look to the owner for more local pricing. And so we also have conflicts between the pricing that shows up in a physical needs assessment and what the owner can actually achieve in the field. And we find a lot of success with our PCNA PCNA folks accepting the pricing from our owners, assuming it's been given to them by a third-party professional. So the PCNA is probably one of the most important tools in this process, and it's not something that's static, and it's not something you aren't to be involved with. You are supposed to be involved with it in helping to develop the best scope of work. What the bullet also says, what the slide also says, is that there'll be two critical elements of the PCNA. One are called critical repairs, and what that is, those are typically immediate life safety issues that are found in the inspection. For instance, GFCI outlets aren't done in the kitchens or bathrooms. Smoke detectors aren't up to code. Right now we're getting called on basically a few global things, and that would be the GFCIs, the smoke detectors that need to be outside of the sleeping area in addition to inside the sleeping area. And then any trip hazards. These items would need to be done prior to the closing from funds available from the owner's cash flow. The good news is that we put those into the development budget, and you do typically get reimbursed for those costs, but you have to do them in advance of closing, even not contingent upon a closing. And one might even go and stretch and say that they would show up on your REAC anyway if you didn't get them done. The second piece are the non-critical repairs. This is basically your scope of work, those things that you're going to do during the repair period after you close on the loan. This is what you do as a combination of what the PCNA folks find that you need to do in the next 12 months, those things that are going to expire or need to be replaced in 12 months, which generally isn't a long list because most everything, you know, there's a flow and a pattern to how things are replaced, and that gets combined with the owner wish list. And again, there's a finite amount of money in a 223F refinancing as with any other. And ideally what you are doing is you're figuring out how large of a construction budget you can have and what the cost of the items you want to replace are. And you and the PCNA folks and the lender are coming together to develop your non-critical repair list, which becomes a part of the PCNA, which becomes basically a part of your financing package. There is a pilot program that I think has been getting a little bit of press now. The 223F program, as we talked about earlier, it limits the amount of money you can spend on a per unit basis. Well, the pilot program basically recognizes that the 223F program is one of the easier lending vehicles that HUD has access to. And I think the idea was that we're going to enable the F program to be combined with low-income housing tax credits, which we'll actually talk about in the next lesson. And so we have this pilot program. It's discussed in Housing Notice 12-01, and the pilot uses the 223F program to test a new process to streamline and expedite the processing of refinance and acquisition of multifamily properties that use tax credits, low-income housing tax credits, LIHTCs. There are three key property types that can apply under the pilot program. The first is the refinance of assisted housing projects, meaning they have at least 90% of the units are covered by Section 8. The second is the refinance of older properties that had tax credits, so they were originally financed through a low-income housing tax credit program, and they're now re-syndicating. And re-syndicating simply means that they're going to apply for new tax credits to recapitalize their property. And the third is the refinance of newly constructed properties. So if a property has been recently constructed, perhaps within that 3-year window that's typically excluded from the F program, it could be refinanced under this pilot program, combining tax credits and the 223F. Under the pilot, the repairs can actually go up to $40,000 a unit, so you greatly exceed the typical maximum under the normal F program. And the pilot will start in Boston, Chicago, Detroit, and LA, and they expect it to expand to other offices at later dates. So what we are hearing is that they've just approved the MAP lenders that can work in this pilot program, and for any of the offices in those list of 4 cities that still have tax credit rounds, we apply for low-income housing tax credits in every year. It's possible that we could see some of the first pilot applications come out this year. And that if it's a successful program and these first pilot programs do well, then we could hopefully see it be expanded to other offices. Let's look at the underwriting requirements for the F program. So this is for a refinance. If you're going to use 223F funds for a refinance, these are your underwriting requirements. And this is very high level, and we're not going to be able to get into much math around this, but this is what your lender would use to size your loan. This is how the criteria used to size your loan. So in the first row, let me first say that you're going to be sized at the lesser of these three formulas. So you're either going to be what we would call loan to value constrained, meaning the loan to value creates the lowest loan amount, or debt service coverage ratio constrained. Typically, those are one of the two of those creates the lowest loan amount, and rarely does cost come into play. So in looking at the first two lines, you have three columns. One is for a market rate deal, one is for affordable, and one is for 90% rental assistance. Often we get asked, how do I know which column I fall under? Well, obviously the far right column, you'll know you're under the 90% if you have at least 90% of your property covered by a Section 8 rental assistance contract. In the affordable category, there's a long definition for what is considered affordable. I believe it's generally that you, in addition to having perhaps having some rental assistance, you also need to have a land use restriction agreement or some other use restriction that restricts you to an affordable client base for, I think it's more than 15 years. And if neither of those two apply to you, then you'd be considered market rate. So there are folks out there with less than 90% Section 8 and do not have a use restriction or use agreement. They're going to fall under market rate, even though they may be serving some low-income folks in their property. It gets increasingly less conservative as you run across the columns. So under the market rate column, your loan cannot be any larger than 83.3% of your loan to value ratio. Must not be more than 83.3%. And I'll pause and say that the value here is as determined by an appraisal that your lender will get. And the appraisal, as you can imagine, has many components. And one of those is you will be looking at a lot of variables that could be affected by you and your project team. For instance, in the appraisal, you can consider post-rehab rents if you're going after a rent increase, as Margie talked about in the last lesson, that might be marking up to budget or marking up to market. Your appraisal could also consider the fact that you consider the rehab that you're going to do. So if you're doing a substantial amount of repairs that might change your comparables for your appraisal, that can be considered in the appraiser. And so the appraiser will come up with a value, and that's the value to which the loan-to-value ratio is applied. The loan-to-value ratio goes up across the line, so it's 85% maximum for an affordable project, and 87% maximum for 90% for rental assistance. The debt coverage ratio is the next column. It gets increasingly less conservative across the band there. And debt service coverage is simply that ratio whereby the net operating income, which is that income after vacancy and expenses are taken into consideration, divided by the debt service. And those are your maximum debt service coverages you can have under this program for each of those categories. We have another slide for if you're going to use the F program for acquisitions. It's the same numbers, except we have a third criteria, which is called the eligible transaction cost, and you can see that across the bottom. Some more underwriting criteria for the F program, if you're going to consider it. You would want to make sure that your occupancy is at least 85% or higher, and that's a healthy criteria to make sure you're not in any sort of trouble with your market or your ability to lease your units. Now, there is a caveat, which is if you are considering a transaction, and a big piece of it is to combine efficiency units into one-bedroom units under the combining efficiency to one-bedroom unit rules, which require you to have 25% vacancy, you certainly can then bring forth that information to your local HUD office and appeal for some flexibility around this condition, because you're going to necessarily exceed 15% vacancy, which is what 85% occupancy would be. Secondarily, after you get to your minimum physical occupancy, you have maximums. The first is that you can't have even if you're experiencing 100% occupancy, 99% occupancy, they're still going to underwrite you, which means they're only going to give you credit up to 93% occupancy if you're a market rate deal, and 95% if you're affordable, or which includes those that have over 90% HAP. And so despite the fact you may be operating at a higher amount and you may actually be achieving a higher income, this is going to cap your income that they'll use to underwrite the size of your loan. The third point here is you must demonstrate a pattern of stable occupancy that's above the standards that's above standards for a 6-month period prior to submission of the application. So basically what that's saying is, since we're going to be underwriting you to perhaps 93% occupancy, your goal would be to operate at least at 93.5 or some number above there, and it needs to be occurring for 6 months or more. If you're at 92% occupancy for 6 months or more, you're actually going to be brought down to that figure. So it's very important to get your occupancy not just up to 85%, but above the amount that's being underwritten for you, to maximize your loan potential. And then it says here that a market study may be required in volatile or declining markets, and that's just something that we say that, as a caveat to anything that has outlier occupancy standards, vacancy rates, or rents in your market. Additional information on the F program. When you're looking at a 223F loan, your maximum loan term is usually typically 35 years. It says the current rates are 3 to 5%. We are seeing deals are closing right at 3%, and I've heard that they are closing under 3%. So I don't know how long that's going to last, but it's certainly a good day for this loan. FHA, these are non-recourse loans, meaning that the only thing that the lender has to grab is your collateral, so you're not going to worry about it coming back to you for personal guarantees or coming back to the corporation. The loans are assumable with FHA approval. Repairs are funded through a repair escrow, and those must be completed within 12 months of the loan closing. So in the 223F program, at closing, you will have set up with HUD an amount of money that can be used for the repairs. You must expend that money and do the repairs within 12 months of closing. And if you're looking at a project that takes 12 months to renovate or to do the repairs, you probably are talking about something that is more like substantial rehabilitation. It's another trigger to throw you out of this program and perhaps into the D4 program. And then we have, these are direct-to-firm transactions. This basically indicates there's fewer steps in a 223F transaction than there are in the 221D4 transactions. This is the last slide we have on 223F, so I have a few more points to make. Right now, this is a very, very popular program. There are a lot of preservation strategies are employing this, and it's for multiple reasons. One is that the size of the loan typically is the right size for the project. This means that given with typical NOIs and typical expenses of many of these old 202 and old 236 programs, they are not resulting in loans that would even trip you up into the 221D4 program. They fit nicely into this. But that also means that typically we're seeing loans that could be as small as $1 million, often $2 million. And because HUD caps the fees on these, it can be problematic for every lender out there to imagine doing a deal that's maybe less than $3 million. Don't be discouraged, though. If you're an owner and you're looking to do a project and you don't see yourself borrowing more than $1 or $2 million, there are lenders out there that are HUD and MAP approved that will work with the smaller transactions. You do have to maybe look a little harder for them. In those cases, you would expect to pay what I'd call full fees. They would maximize their fees, but there should be a way to get those done as well. And then my last little note on this, and it applies to the D4 program as well, is MAP-approved lenders are, HUD-approved, and they understand the processes to go through this. And when you're, a question we get is how to find the lender to work with you, and they're all going to meet a minimum bar of qualifications. Outside of that, a distinguishing factor I would look for is those that have worked with your local HUD office. And Margie, implied this before, and I can't stress it enough when I talk to folks, that what we're talking about in these webinars is general information that's fairly factual information based on notices and HUD processes. However, things do vary on a case-to-case basis with your property as well as with your local HUD office. So finding a lender who has experience with your local HUD office can be often critical in a successful project. It means the relationships are good and finely tuned, and that people know each other, and just getting through what can often be a little bit of a complicated process might go just a little bit smoother. So let's go and talk about the next FHA program. It's the 221D4. We call this the Substantial Rehabilitation Loan Program because it's mainly set up to do larger scale renovation. As with the 223F, these are non-recourse, assumable construction and permanent financing for new apartments or for the substantial rehabilitation of existing apartments. So you can build a new property using these funds. Similar to the F program, it has requirements for repairs except these are minimum requirements. The cost of the repairs must be more than 15% of the estimated replacement cost, and it must be more, or it must be more than the $6,500 per unit number multiplied by your high cost factor. So for instance, if your high cost factor multiplied by 6,500 led you to $18,000 a unit, and you worked on everything and figured out that you needed $25,000 a unit in repairs, perhaps you're going to fit better into the D4 program. And then it says also, or 2 or more major building components may be replaced regardless of cost. I would say that's typically an and. You're not going to usually spend the kind of money you spend under the D4 program and not replace more than 2 systems. It's just almost impossible. So we see a lot of wholesale renovations through the D4 program, meaning full kitchens, bathrooms, and all that business, and that would definitely trigger more than 2 building components being replaced. We have a chart that's similar to the F program in the underwriting requirements. So the same categories, we have market rate, affordable, and 90% rental assistance. And these are actually less conservative even than the F program. Your debt service coverage ratio can come all the way down to 1.11 under the, if you have a property with 90% or more rental assistance. And your cost, loan to cost ratio, loan to value ratio goes up to 90% on the assisted projects. Again, loans are assumable. Maximum term of a D4 is 40 years, fully amortizing, plus the construction period added to that, or 75% of the remaining useful life. Usually we see it go out to 40 years. These are non-recourse loans with what we call standard carve-outs, and that's basically also referred to as the bad boy carve-outs. So if you do something that I think is falling into the lying, cheating, stealing category, you could see yourself, they could go after you, but generally we look at these as non-recourse loans. They are assumable, subject to HUD approval. You also must have 5 or more units in your project. And different from the F program, and this is actually a good reason to contrast the two, Davis-Bacon wage rates apply in a D4 program. And Davis-Bacon wage rates are simply the HUD approved wage rates that you must use to pay for the renovation of your program. In many cases, they can add a lot of cost to your renovation. So in certain areas of the country in particular, when they do apply, it actually adds a premium to the cost and can increase the size of your project. It can also increase somewhat complexity to your project, and it can shrink the pool of available contractors to you, because the contractors have to understand the program, understand Davis-Bacon wage rates, and agree, of course, to use them and apply them. Under the 223F, Davis-Bacon does not apply, so it's a nice distinguishing factor between the two. There are no income limits on renters. There are no income limits on renters on either of these programs, we should point out. And the statutory restrictions on the mortgage, on the maximum mortgage per unit. There's in the same place where you will find the high cost factor, you'll also find a maximum amount you can spend per unit under the D4 program, and in some certain high cost areas you would have to watch out for that. I'll also point out that under the D4 program, you do not, you do need to expect to have stamped architectural drawings. Under the F program, you do not, and that's also a nice distinguishing factor. It means that the pre-development process under your 223F program is often shorter, less complex, and less costly than it is under the D4, which does require stamped drawings for good reason, because you're doing substantial rehab, and HUD wants to make sure you have the right folks on board to get you through that process. Additional information for the D4 program. It's a 2-stage process. There's a pre-application and firm commitment. However, if you have Section 8, you can what we call go directly to firm commitment application, which just shortens the process or streamlines the process. It's considered a construction to permanent financing loan all in one. So after the rehab is completed, there's what we call a final closing, and the loan transitions to permanent financing for up to the 40-year term. Mortgage insurance requirements, this applies to both the F and the D4 program. There will be a regulatory agreement. You must be a single asset entity to apply for a loan under these. So I'll pause here and say that in certain scenarios that are prevalent throughout the country, which is the single asset nonprofit owns a 202 project, for instance, and this is all they own, they typically own it under there's only one owner to that project. It's whatever their corporate name is. To apply for the D4 program, and if they want to own multiple projects in the future, what we often advise is to set up a new LLC and that nonprofit entity moves the asset into the LLC. That LLC is then the owner, owned by the nonprofit, and it allows the nonprofit to then go about and set up perhaps multiple LLCs to own future projects. Otherwise, it can be complicated. So if in the instance you have multiple properties and they're all owned under one umbrella, you would be required to set up the LLC and move your asset into that. It's a typical part of the process. It's not overly cumbersome, but it is something to be aware of. It typically does not trigger the payment of property taxes if you're tax exempt at the moment, and it does not trigger the payment of income tax moving it into an LLC if the parent is a nonprofit company. These, of course, are non-recourse loans, as we discussed earlier. These are fixed interest rate loans for through the construction and the permanent loan periods. There'll be an amortization schedule or amortization plan that you can refer to that shows you how the principal and interest is paid down over the term. And then there's a HUD application fee of 30 basis points. And I'll go on to the next slide because this gets into the fees. The HUD application fee of 30 basis points based on your loan size, that's a fee that you'd be expected to pay prior to closing from money on hand. So typically, to go over the fees that are paid out of pocket before closing, we would have the inspection fee, the application fee. The lender gets a fee that's a processing fee, typically $7,000 to $10,000. And then you're also paying the lender what we call due diligence fees to order the appraisal, the PCNA, anything that's needed, the phase one. These are all expenses you'd be expected to pay out of pocket before closing, but could be reimbursed at closing. Let's go through some more of these fees. At closing, you would pay a HUD inspection fee of 5 basis points. That's the fee back to HUD for their inspection services. You also will be expected to pay a mortgage insurance premium. The 45 basis points is your ongoing premium. That's what you would pay after your closing. Typically, though, at closing, you pay 1 to 2 years of that at closing. Either you pay 0.9 and up to 1% of MIP at closing to get you through the next year or two, depending on which loan you're in. The lender fees and charges, so HUD maxes out the amount of fees that can be charged by the lender to 3.5% of the mortgage amount. It says here fair housing and equal opportunity. You must be compliant with that area. You must not have any issues with your 2530 form, your HUD 2530. And in the 221D4 program, you're going to be required to set up an operating deficit escrow. And you will have replacement reserve requirements, and that's part of what the PCNA does for you. The PCNA will look at your the term of your loan, the life of the property, and one of the things it does, in addition to determining critical repairs and non-critical repairs, is it determines an upfront amount of replacement reserve that must be in the bank at closing to get you through the next year or two, depending on which program you're in. And then it determines your ongoing replacement reserve contribution amount. And this is something that looks at what the expected replacements are over the coming 30 or 40 years and does the math on that. And then lastly on this slide, we have an environmental review that would be required. Again, out-of-pocket cost, the HUD application fee and the due diligence fee paid to lender, I'd add to that. Typically, you're going to also pay the lender their application fee, the fee to engage them. And then developer fees are something to not forget to talk about. Borrowers may receive a developer fee as a part of the transaction. There's 2 notices here to reference. For the 221D4 transactions, you would look at notice 96-63. And for a 223F transaction with a 202 project specifically, you'd look at notice 04-21. We don't have any guidance on a 223F transaction of a 236 program, so there is some talk about that, but there isn't any specific guidance on that. Well, there's a quick comparison here of the F and the D4 programs. So the F program does a rehab level that is less than $6,500 a unit times your high cost factor, and the process is called direct affirm. So it's a quicker and more expedited process. And then for tax credit program projects that you want to use, you only can use it under the pilot program. So you cannot use an F loan anywhere, everywhere. You can only use it within the pilot program. And looking at the D4 program, the rehab level is actually going to be greater than the $6,500 a unit times your high cost factor. You have a 2-step process, although in some cases it's a 1-step process. And as of right, you may combine the tax credits with a D4. In fact, that's a common way of providing financing. That is the end of the FHA module. We have one review question that may show up on your pre-test or post-test. The first one, the one question is, when applying for an FHA insured loan to refinance or rehab your property, who drives the loan process? And that's an interesting question because I actually harp on the fact that the owner is a big part of this. The technical answer is that your HUD-approved lender drives the process. They really do. The owner, though, is right there, should not be pulled along, but should be right there beside the lender. We had two objectives in this lesson. One was to identify the property and owner eligibility requirements and the incentives associated with obtaining the 223F and the D4 loans. And the second was to identify the steps required to apply for an FHA insured loan to refinance or rehab your property. I think we did both of those. So with that, we'll close this lesson and we'll come back at 2:30 Eastern Time to have a lesson on tax credits, and that'll be the last one of the webinar. Thank you.